Good morning and welcome to Charting Markets on Wednesday, the 28th of February 2024. Earlier this morning, we had the Reserve Bank of New Zealand, which kept its interest rates unchanged, but which also changed its narration with regards to possible further rate hikes being seen. And on those rather dovish statements, the Kiwi dollar declined quite sharply, and I'll show you that chart later on against the US dollar. But let's start off by having a look at today's economic calendar. And we have at 1:30 p.m. the second preliminary estimate of the fourth quarter US GDP growth rate out. And then this will be followed by a speech by the MPC member, the monetary policy member of the Bank of England, Mr. Mann, speaking at 3:30 p.m. And then we also have at 5 p.m. Mr. Bostic speaking from the Fed, and also at 5:45 p.m. Mr. Williams. So we've got some Bank of England and Fed speakers today, but basically the markets are really far more interested in the fourth quarter GDP data out of the US. And then more importantly, even than that, tomorrow's Fed preferred inflation gauge, the PCE inflation data, which will be watched very closely, and also Eurozone inflation on Friday. So let's begin having a look at the FTSE 100. We can see here that the FTSE 100 is weakening, and already started to weaken earlier this week when iron ore prices fell quite drastically, and this dragged down miners, which are a large constituent of the FTSE 100. As you can see here, we're now testing the orange line, the 55-day simply moving average at 7,637 on this daily financial bet, and are heading down towards the 21st of February low at 7,623. Now below that, we've got some pretty good support area around the 7,600 mark, and that goes back to the early February lows. So this support area is likely to hold, but if it was not, that weren't going to be the case, we could perhaps head all the way back down again towards the red line here, the 200-day simply moving average at 7,542. But right now, it looks as if further weakness is in store for the FTSE 100, And this view would only change if it were to rise above last Friday's high at 7,717 on a daily chart closing basis. The German DAX 40 contract looks quite different, though. As you can see here, we are heading to new record highs, have now risen above the 17,600 mark, and continue to advance as the latest earnings season highlighted that European stocks remained undervalued compared to their American counterparts with regards to PE ratios, the price to earnings ratios of these companies. And this has attracted further investment in Europe's largest economy, Germany. And we also saw yesterday German consumer morale basically improving slightly, all of which has led to new record highs being made here with regards to the DAX 40 contract and also on the Euro Stoxx 50. So European stocks looking really, really healthy here. And the German stock index trading in new record highs. Now above here, we haven't really got any upside targets, 17,700 perhaps, but basically we're heading towards the psychological 18,000 mark, provided we stay above this accelerated uptrend line, which today comes in around 17,462. And from a trending perspective, we would really have to fall through the last reaction low, but that goes all the way back to the 20th of February low at 17,020 for us to basically no longer be in this very steep uptrend. In the US, the picture is slightly different, though. If you look at the S&P 500, and you can see the same happening on the Dow Jones Industrial Average chart and also on the daily NASDAQ 100 chart. And what I'm saying here is basically the following. Last week's high made on Friday at 5,111 on the daily financial bet basically was above the high seen in the middle of February. But if you look at the relative strength index at the bottom of this chart, you can see that we have got a lower high made last week compared to the high made on this oscillator in mid-February. And this is called negative divergence. And when you have negative divergence in an uptrend, it is telling you that at least short term, there might be some weakness coming into this trend. So what we might be seeing is further consolidation over the next few days, take us back down again towards the 5,049 high from mid-February. And below there, we also have the October, November to February uptrend line around the 5,000 mark, which may be retested in the days and weeks ahead, provided we stay below the 5,011 highs seen last Friday. Now, if we were to rise further, the next upside target would be around the 5,200 mark on the S&P 500. The US dollar regained some recently lost ground in the course of the last few days, despite US durable goods orders coming in much weaker than expected yesterday. But you can see here that what I would like to look at now, which is actually more interesting, is the New Zealand dollar against the US dollar, where you have strength in the US dollar taking the currency pair down. But most importantly, what has also happened here overnight is the Reserve Bank of New Zealand basically being more dovish and pushing potential rate hike expectations further back and even talking about perhaps potential rate cuts. So basically what we're seeing here is a fall in the New Zealand dollar against the US dollar, taking the currency pair back towards the red line here, the 200-day simply moving average at around 60.77. And below there, we have really good support going back to the late January to current February lows, going back to around 60.39. And as long as that support area holds, we just remain in this sideways trading phase. But you can see here, we advanced very gradually and gingerly since mid-February, with small candles to the upside being seen. And now we're seeing just one big whack to the downside on this dovish New Zealand Federal Central Bank. So here, the currency pair clearly short-term looks bearish, and for bullish reversal to be seen, which I don't expect to happen, to be honest, we would have to rise above the orange line, the 55-day simply moving average at 61.81. The Australian dollar has similarly suffered against the US dollar. As you can see here, it's also coming off in line with the New Zealand dollar. And you can see that we have so far slid to around 64.90. And that is a 1 week low, taking us back down towards the early February low at 64.69 and also the current mid-February low at 64.63. So that is a potential support area. As long as it holds, though, we might see further sideways trading. What is interesting, though, from a technical perspective, is that last week's highs were made around the 200-day simple moving average here in red, 65.63. And basically, since we then stayed below it, we now accelerated to the downside once more. And for the bulls to be back in control, we would really have to rise above this 200-day simple moving average at 65.63 for this current downward spiral to be negated. The US dollar against the Japanese yen is also very interesting, as the central bank is expected to hike its rates by 10 basis points later on this year. But for the time being, you can see here the US dollar is still gaining ground against the Japanese yen. And we traded basically sideways for the last 2 weeks, but have held yesterday above the December to February uptrend line. As you can see here, we dipped down to around 150.08, but held above it. And we are currently heading back up towards Monday's high at 150 yen and 83 sen. And if we were to rise above there, we've also got the mid-February high at 150.88, which is key because a break above there could take us back to the all-time record highs around the 151.91 mark. So further upside is in store, provided we stay above yesterday's lows at 150 yen and 8 sen. The slightly stronger US dollar has had a negative impact on the gold price to some degree. As you can see here, we have started to keel over around the orange line, the 55-day simple moving average over the last few days as the US dollar appreciated, making purchases of the precious metal more expensive. And you can see here that we did rise on Friday of last week to $2,041 per troy ounce, but since then have traded sideways around this orange line, the 55-day simple moving average at $2,034 per troy ounce, but seem to be heading back down again at the moment towards this 5th of February low at $2,015 per troy ounce. And interestingly enough, also Friday's low was made slightly above the $2,016. So basically, we've got a support area that we are aiming for between $2,016 and $15 per troy ounce. And as long as that holds, everything's still fine. The recent uptrend for the mid-February lows is still intact. But if we were to fall through $2,015 per troy ounce, there is a pretty good support area going back to the October and late November highs, and also the mid-January lows between $2,009 and $2,002, which may then once again hold the precious metal in the days ahead. For the bulls to be back in play here, what we need to see is not only a break through the December to February downtrend line, but also rise above last Friday's high at $2,041, in which case we could retest the highs seen back in mid-January and also early February between $2,062 and $65 per troy ounce. But right now, as you can see here, we have a series of lower highs and lower lows, which is a definition of a downtrend. So therefore, it's more likely that the gold price would once again head down again. Brent crude oil is kind of interesting at the moment because investors are basically weighing up future supply concerns, potential supply concerns with regards to ongoing heightened Middle East tensions and no ceasefire being found for the Gaza Strip. But at the same time, investors worry about future demand because of China's lackluster economic recovery after the pandemic. And you can see here that the oil price is reflecting all of these worries and concerns. Basically, as you can see, we've just been trading sideways around this red line here, the 200-day simple moving average around 81.93 on this front month futures contract. And basically, we're just trading in a sideways trading range, and we'll continue to do so provided we stay above Monday's low, I should say, at 80.25. As long as that underpins, further sideways trading is in play. And on the upside, as long as the 83.24 mid-February high caps, the sideways trading range also remains intact. And we'll have to see where we will break out of this sideways trading range. If we were to rise above 83.24, the highs going back to mid-November between 83.79 and 84.55 might once again be in focus. However, if we were to fall through 80.25, we would most likely not only just touch the orange line here, the 55-day simply moving average at 79.47, but also probably retest the December to February uptrend line, which currently comes in around 78.55. But right now, further range trading around this 200-day simply moving average is most likely to continue to occur. I'd like to also have a look at US natural gas futures prices, because they dipped down to multi-year lows last week, and you can see here that since then, because of production cuts by US natural gas producers, the natural gas price rallied to around 187 in the middle of last week, and since then we've just been trading sideways basically. So here it is possible that further sideways trading with a slight bullish stance might continue over the next few days, provided we stay above Friday's low at 168 and do so on a daily chart closing basis. And if we were to rise above last week's high at 187, we could then retest the psychological 2 mark again on this front month futures contract. But right now, not much going on here, but it looks as if, at least in the short term, a low is in place for this major long-term downtrend that we've seen over the last few months. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG.